Okay, so this is the video overview of Chapter 12, Shareholders' Equity. To understand what shareholders' equity is, you have to understand, first of all, need to understand what a corporation is. Corporation has two characteristics. It's a form of legal organization of a company, and that has two features. One is that there's limited liability of owners, that the owners basically, if the corporation goes bankrupt, that they can only be sued or lose money to the extent of their investment. Their personal assets are protected. And generally there is double taxation, because if most corporations are what's called subchapter C corporations, so they're taxed both on corporate level, and also then dividends are taxed on the individual level of investors. There's something called subchapter S corporation, which is a type of organization which is restricted only certain types of businesses, where double taxation could be avoided. So most corporations, most companies that you can think of, Microsoft, IBM, Google, and so on, there are subchapter C corporations that have both double taxation and have legal liability of owners. The owners of the corporation are called, of course, shareholders, meaning they're called a share of the company's stock, or shares of the company's stock. They have a claim on the company's net assets. If you remember, net assets are assets minus liabilities. That's the equity of the company. Shareholders, of course, are different from creditors or debt holders in several respects. First of all, they're not guaranteed any return on their investments. They can lose all of their money, but then they have the unlimited upside, right? In the sense that the shares, the amount of return is potentially unlimited. Whereas the debt holders, they have more protections from default, right? Their downside is limited, but their upside is also limited by the amount of the principal and the interest they can earn. Shareholders are what's called residual claimants to the assets of the corporation. That is, if the corporation goes bankrupt, they're paid last. They're paid last after the creditors, after the government, after the employees, and generally it means in a bankrupt company, equity holders are left with nothing by and large, most of the time. But unlike creditors and other parties, they have voting rights in the corporation. They have the right to elect the corporation's board of directors, and through the board of directors, they can hire and fire executives, meaning the management of the corporations. The board of directors' role is to represent and protect interests of shareholders. The board of directors is what's called a fiduciary agent of the shareholders. It's required to act in the shareholders' best interest. They have to put the shareholders' interests first above their own. As I already mentioned, shareholders get dividends, which are subject to double taxation. The corporation, when it's organized, it has a charter. It has to file what's called a charter, which is the basic document that stipulates what this corporation is. It's filed with the state in which the firm incorporates. Among other things, it spells out it's the name of the corporation, name of people organizing it, the original shareholders, number of authorized shares. Authorized shares are shares which are allowed to be issued, not necessarily issued shares, but kind of the maximum what could be issued. Number and names of initial board of directors, and location of the corporation's registered agents, that is the office where it served legal papers. About 50% of corporations in the United States are incorporated in the state of Delaware, and the reason for that is that Delaware has one of the most friendly corporate laws, pro-business corporate laws. So many companies choose, the majority of companies, in fact, chooses to incorporate in the state of Delaware, and the rest, the other 50%, is dispersed among the remaining states. Besides the charter, corporation has the bylaws, and bylaws is a more detailed document, stipulates how the corporation is to conduct its governance business. So bylaw is a rule governing the internal management of an organization, such as the business corporation. Bylaws generally cover topics such as how directors are elected, how meetings are held, which directors, which officers the organization will have, and the description of their duties. And bylaws could be amended by the board, whereas the charter is much harder to amend. Charter is a more basic document. You can think of the charter as kind of the constitution of the corporation. And both charter and the bylaws are public documents which you can view on the websites of the company. Anyway, now let's turn to accounting a little bit more. So there's different types of equity shares. There's what's called authorized issues and outstanding shares. Authorized shares I already mentioned. This is the maximum number of shares that the company is allowed to issue under its charter. Issued shares are the actual issued shares that are actually been issued. So the number of issued shares is always below authorized shares, or could be the maximum of authorized shares. And there's also outstanding shares. Those are the shares that are actually out at the shareholders' pockets. Now, what's the difference between issues and outstanding shares? That's because some shares could have been bought back by the company and they're held inside the corporation. That's called treasury stock. They're held in treasury, that is, they're not outstanding. They're issued, they're printed, but they're bought back. So essentially, effectively, they've been taken out of equity temporarily and they're sitting in treasury stock. Common stock. So, we're down to kind of talking about basic types of equity. So the shareholders could either be common, what's called, or preferred. And I'll get to the preferred in a minute. Common shareholders are the most common types of shareholders. They have the least amount of rights, I would say. They have, in the sense of cash flow rights, right? They have the least amount of rights to dividends. The dividends to common shareholders are not guaranteed. However, they have the right to vote. They have the right to vote for the company matters. And you need to know about a legal capital. Legal capital is the amount of common shares that cannot be withdrawn from a company, and that's usually equal to the par value of the stock that is issued and outstanding. And that's basically a legal concept, not an accounting concept. Some shares wouldn't have a par value, but in some states you're required to have this legal capital. So, typically it's like $1 or 50 cents per share, and that's tracked in a separate account called par value of common stock. If, of course, most shares are issued for value far exceeding the legal capital of the par value, in that case, whatever excess there is kept in a separate account called additional paid-in capital or excess over par and stuff like that. So those are common shareholders. Their biggest, again, they have not guaranteed dividends. In fact, if the dividends are paid, they're last in line to get them, but they have the right to vote. Juxtaposed against them are the preferred shareholders, so the preferred stock. The preferred stock is kind of in between debt and common stock, right? It stands between debt and common stock in terms of rights. Preferred shareholders have more rights to dividends. In fact, they're paid dividends first before common shareholders. And their dividends could even accumulate, right? So in other words, they're cumulative. Certain preferred stock could be cumulative. In other words, even if in a particular year dividends are not paid, and companies are not required to pay dividends, but if there are preferred shares and they're cumulative, whatever unpaid dividends accumulate over time, and in such a time the dividends are paid, you have to pay out those cumulative dividends, which makes it, of course, sound like very much like interest in some ways on debt. So that's what it makes it closer to debt. But typically, the preferred shares do not vote, so which also makes it similar to debt. The other term for cumulative dividends which have not been paid are dividends in arrears. And like I already said, dividends in arrears are paid out next time the dividends are actually paid first. Now let's go through some basic accounting issues. So, for example, MBNP form an MBP corporation by contributing $1 million each. MBP authorizes 10,000 shares to be issued, but issues 3,000 shares to MBNP. Shares have a $10 par value. All right, so in this case, what's contributed in terms of cash, debit cash is $3 million. Then you need to credit common stock par. In this case, there are 3,000 shares. Each share has $10 par value. So you credit 30,000. That's the legal capital, right? We simply allocate it because the state law requires it to say, okay, that's how much you have to keep in legal capital and the par value. This cannot be withdrawn in case of bankruptcy. And the difference is the plug number goes to additional paid-in capital, 2.97 million. All right, now, one thing that you remember is that whenever shares of the company are sold between individual investors rather than originally issued, so the company issued shares, you have a journal entry like this, originally issued shares. But then, people buy and sell stock of various companies on the stock exchange in what's called secondary market. Those secondary market transactions, the corporation does not track. It doesn't affect its books. It only affects the investor's books. So the principle is, unless corporation is a counterparty to such transactions, for example, if it actually buys back shares or something, transactions between individual investors do not affect corporations' books. So that's something to remember. So that's a stock issuance. Then what about stock repurchase? Stock repurchase is a situation where the company might decide to buy back its shares, right? Maybe it thinks, well, the stock is undervalued, and maybe it wants to help it wants to help the stock price. Stock buyback is also a way to distribute capital back to shareholders, so it has too much money on hands, and rather than to pay dividends, because dividends are subject to double taxation, they want to buy back shares. And when the company buys back shares, so long as the investor held the stock for at least a year, they're taxed at a lower capital gains tax rate. So that's a way to return capital as well. So, or is a way to maybe move away cash from debt holders. That's kind of what's called that. If the company, if they want, that's not a good reason to. But most of the time, it's for to return capital. They have excess cash that they want to return, maybe because they believe the stock is undervalued, that they buy back shares. So you do the stock buybacks is accounted through an account called treasury stock. So treasury stock is like an account where unless the shares are formally retired, they're kind of held in that account. It still reduces equity. Unless the company decides to formally retire the shares, that is, destroy them, take them out of circulation completely, that's kind of a temporary holding place for those shares, because they can be reissued. They can be sold back to the market. So in this particular question, we buy back 100,000 of shares at $20 per share. So most companies ignore the original issuance price, ignore the original par value. They just record it at what's called cost method, which means they will debit treasury stock at $2 million and credit cash at $2 million. Now, treasury stock is what's called a counter equity account, that account reduces shareholder equity. It's a reduction in shareholder equity, but that basically we don't take the shares out of circulation entirely. We don't take them out. We keep them in this treasury stock account because they're issued shares but not outstanding shares. So we don't remove their par value, we don't remove the original paid-in capital unless they are retired later. In this case, the shares have not been retired. So that's why we keep it in this treasury account. When we later on decide to reissue treasury shares, let's say we issue them at $30 per share. Well, they get $3 million for it. You take out the treasury, you credit out the treasury stock account, you zero it out, and you have an additional, this extra $1 million that you get goes into additional paid-in capital, and it's usually marked separately in the treasury stock of $1 million. And that's it. In this particular case, I bought shares back and I reissued them back. Treasury stock is gone. What we have is, after two transactions, is net increase in additional paid-in capital. Now, what if we decide to retire the shares entirely? Now, if the shares are entirely retired, then you need to remove, if you buy shares back, then you need to remove, not just keep them in treasury, but remove the original, whatever the original paid-in capital was on those shares, both par and additional paid-in capital. All right, so now let's talk a little bit about dividends and how they're accounted for. So first thing to remember is that stock repurchases and dividends are accounted for, they're economically the same things, right? They're both forms of return of capital to shareholders. So dividends could be of cash nature, and most of them are cash payments, but it also could be in the form of property, or in the form of stock, in other shares of stock, or cumulative dividends on preferred stock. So let's look at some examples of what we could do here. So some of the things to remember about dividends are some dates. So first, dividends are declared. The board of directors has to declare that they'll pay dividend in the amount of the dividend. Now, then they also have to decide which shareholders will get paid dividends. So you have to hold shares on a particular date, typically to be entitled to the dividend, and that's the date of record, right? So there's the date of declaration, which is when the board decides how much dividends they're going to pay, and there's the date of record, who is entitled to the dividends, because shares are traded all the time, and you need to decide who is, as of which date, which shareholders are entitled to the dividends. And then finally, There's the date of payment, which typically happens sometime later. Maybe a month or two later when the cash is physically distributed. So dividends are paid out of retained earnings because retained earnings represent undistributed value or value created in the company. If there are no sufficient retained earnings, then it has to come from other capital accounts. So that's a return of capital, or what's called a liquidated dividend. So you can take it out typically of other additional paid-in capital if there is no sufficient retained earnings to pay it out. And if dividends exceed retained earnings, that's again just basically like what's called a corporate liquidation. So here's a basic example. On the declaration date on December 15, 2017, MBP declares $1 per share common dividend to the shareholders on record of January 15, 2018. That is, you will get this dividend if you physically hold shares on January 15, 2018. If you sell them on January 14, 2018, you're not entitled to this dividend, even though you held them on December 15th of 2017. The dividend will be paid in February 1st, 2018. There are 1 million shares outstanding. So altogether is $1 million times $1 of dividends. So you need to, on December 15, 2017, you need to debit retained earnings for $1 million credited dividends payable. It's a liability on that date. When you actually pay it in February, you reverse dividend payable $1 million and credit cash $1 million. That's how you deal with cash dividends. Property dividends, same way, except you're not paying out in cash, but in property, maybe in some physical assets or whatever. The bottom line, if you do it in property, you need to maybe in other corporate investments or whatever. This happens more often in kind of small privately held companies. Then you need to record whatever the dividend distribution at the fair value of the assets you distribute, which is something you can cover in other deeper, kind of more advanced accounting courses. Now, dividends could also be paid in the company's stock. So essentially, the company takes and distributes more shares, essentially issues more shares pro rata to the existing shareholders. So as a result, stock dividends do not result in redistribution of wealth among shareholders. It's just saying, it's sort of like akin to you have a $10 bill, and now it's split in more $5 bills or something like that. That's what stock splits are, which are an extreme example of stock dividends. So everybody gets the same amount pro rata. So there is no, the pie, if you will, it doesn't change the size. It just gets split in finer, thinner pieces. But the relative size of the pie for every shareholder doesn't change when there is a stock dividend. So what does it mean more clearly? So, for example, on December 15, 2017, MBP declares 10% stock dividends to its shareholders. There are 100,000 shares outstanding with $1 par value. The stock is traded at $10 per share on that date. So long as it's a minor stock dividend, below 20% of the shares, you'll account for distribution at fair value of the stock issued. So you need to take 10% of, which is the rate of stock dividends, multiplied by $1 million shares. So essentially every 100 shares, you get 10 extra shares. For every 100 shares you hold, you get 10 extra shares, and multiplied by $10 fair value of the stock on that date. So that together translates into $1 million extra equity issued. So you'll debit $1 million retained earnings, but then remember what you issue is the extra dividends, right? So you need to essentially, you print in more shares, so you credit common stock par value 100,000 because you're issuing 100,000 extra shares, right? That's 10% out of $1 million is 100,000, and they're at the $1 par, so that's how you get 100,000. The difference goes to additional paid-in capital. The bottom line is you can see the total change in shareholders' equity is zero because you reduce retained earnings, but at the same time you increase the number of shares outstanding. So that's what I mean. But total amount of the pie or total distribution of the pie does not change. It's basically moving. Stock dividend is basically moving equity from one pocket to another, from the retained earnings into the actual shareholdings. All right. The extreme example of the stock dividend is called a stock split, where it's when the rate is 100% or 200% or 300% or vice versa. So one share of stock turns into 2 shares of stock or 3 shares of stock, Or on the other hand, every 2 shares of stock gets replaced with 1 share of stock. So that's where my example with a $10 bill being equivalent to $5 bills is more appropriate. So essentially, there's no change economically whatsoever. It's just like replacing 1 share of stock with more shares of stock of smaller par value, or vice versa. So typically, there is no journal entry for stock splits for that reason, because it's like, basically what I told you with the money. It doesn't change the total amount of investment. Economically, stock splits are the same, as stock dividends. It's just a stock split. Like, for example, a 2-for-1 stock split is 100% stock dividend. You get 2 shares for every instead of every 1 share you hold. That's an increase of 100%. When it goes the other way around, when for every 2 shares you reduce the number of shares you have 1 share now of higher par value, that's what's called a reverse stock split. But the bottom line is, whenever there is stock split, there is no journal entry being created. Why do we do stock splits? Because companies sometimes want to change the par value of the stock, want to reduce or increase the number of shares outstanding, to either reduce the amount of shares on the market, because they may want to have fewer shareholders, so they want to increase the demand for their shares, or they want to make shares more accessible to increase their liquidity. But theoretically speaking, it shouldn't have the effect on stock price. However, it does, because it doesn't. If you have more shares available, it reduces the demand for shares. If you have fewer shares available, it increases the demand for shares. So it's a way to attract certain types of investors. If you want the stock to be more accessible to investors who can't afford it, or larger shares, then you may want to do a stock split. If you want to make it less accessible, you may want to do a reverse stock split. So, for example, Berkshire Hathaway, Warren Buffett's company, the shares are over $100,000 each. And so that's because they want only certain types of investors to own those shares. They don't want retail investors to own them. Now, if they decided tomorrow that, we want more retail investors to own our shares for reasons that they may want, maybe because they want to make the stock more popular, so they may split the shares, may do 10-for-1 stock split, split 1 big share into 10 smaller shares, and so on. However, companies do stock splits because they believe that having a larger number of traded shares increases stock attractiveness to smaller investors, thus greater demand for firm shares. This is what I said. The other thing also, the other reason for reverse stock splits is because stock exchanges have minimal stock price requirements. If you fall below, if the company is not doing well and stock price is falling and it falls below a certain level, you may be delisted. So companies that are not doing well and they're facing that problem may do reverse stock split to just boost up the stock price, to turn it from $1 shares to $2 a share, so that they're in compliance with exchange requirements and are not delisted from the stock exchange. And like I said, even though theoretically speaking, stock splits shouldn't really matter, it's just, kind of 2 $5 bills versus 1 $10 bill problem. We know that the market does react positively to split announcements, because probably because of stock splits increase liquidities of companies and increases demand for shares. And that's it. That's all I have on equity. Thanks very much for listening.